Hello everyone. So today we are going to see some basics about the stock markets, how they work, what all we need to do to start trading or investing, and what are the opportunities present in it. So on behalf of Livelong Well Trading community, let me just welcome each and everyone who has decided to take their first step of financial freedom from the stock markets. Now let's get started. The reason why most of us are attracted towards the stock markets is because of the fact that we all know there's a lot of money that can be made from it. And the biggest advantage the markets provides an individual is rather than building a business or starting a business from scratch, we always have the potential in identifying businesses that are doing good, and if we feel they're going to continue their growth, we can invest in them by purchasing shares from the stock market. And if the company is going to perform good as we expect, that means we are going to make profits from our investments. So that is the best thing about stock markets. So rather than building a business from scratch, if we are capable of identifying a company that is doing good, we can make money. Now let's quickly have a look at what stocks mean, what the stock exchange means, and what the stock markets as a whole mean. So stocks are nothing else but an investment that you make in order to own a part of a publicly listed company. So they are also called as shares or equities. So let's say that I feel that company A is going to do good in the coming 5 years, or the management of company A is really good. Their business model is great, so they have a competitive edge compared to the competitors. And I feel okay, this business is going to sustain for the next 5 years, is going to grow really well over the next 5 years. So if I feel so, it's kind of not possible for me as an individual to start a company like company A in a day or two. But what I can do is I can purchase shares of company A, and if the company is going to do good in business, so that means the price of the shares I bought are going to increase, and I'm going to make some money from the investment I have made by purchasing ownership of a company, hoping for good returns when the company is growing profitable or advancing towards further ventures in the future. So now the next question is, then what is a stock exchange? So the basic answer that I can give you is like, just like we have a supermarket for purchasing things that we use on a daily basis. Similarly, we have the stock exchange, which is the supermarket for stocks. So a stock exchange is nothing else but a meeting place for buyers and sellers who are planning to either sell or buy stocks. So just like we have supermarkets for exchanging daily use items, for selling and purchasing daily use items, similarly we have a stock exchange for purchasing and selling stocks. Now talking about the term stock markets. So stock markets are nothing else but a collection of stock exchanges. See, we have a lot of supermarkets. Similarly, we have a lot of stock exchanges. So the collection of the stock exchanges is what we call as, or what we define as, stock markets. In India itself, we have many stock exchanges, but the active ones are nothing else but the Bombay Stock Exchange and National Stock Exchange. Similarly, we have stock exchanges around the world like Nasdaq, NYSE, and many number of stock exchanges. So stock exchanges are actually a subset of the term that we call stock markets. So this is just for general understanding purpose. However, like we use the terms like in the same manner. Both stock markets and stock exchanges, we use it interchangeably. So now we have many e-commerce websites, right? However, if I ask you which are the two major e-commerce websites in India, so all of you will be saying that is Flipkart and Amazon. So similarly, we have two major stock exchanges in India, and they are NSE, the National Stock Exchange, and BSE, the Bombay Stock Exchange. And Nifty 50, it is the index of National Stock Exchange, and Sensex 30, it is the index of Bombay Stock Exchange. I'm pretty sure that most of you must have already heard the terms Nifty and Sensex. We'll deal about that in the coming slides. So all of us have this doubt, like, can I buy any company from the stock exchange? So the answer is, we can buy companies that are publicly listed on the stock exchange, and only those are available for purchase for the public. And now we will be having this doubt, like, then why do companies list themselves on the stock exchange? So there are many reasons. So first of all, let me just tell you what an IPO is. IPO means initial public offering. It is a process in which a company lists itself on the stock exchange for the very first time, and that is what we call as an IPO, initial public offering. So there are several reasons why companies list themselves on the stock exchange, and one of the main reasons among them is to raise funds. So if a company is looking forward to raise capital, so what they can do is they can list themselves on the stock exchange through an IPO, and anyone who is willing to purchase the shares, they will buy the company's stocks, and they'll be paying money, right? So the company in return will be gaining capital. They'll be able to raise funds. It can be for further business expansion. It can be to pay off debts they already have borrowed from uh, banks or other businesses. So it can be for multiple reasons. So one of the major reasons why companies go for an IPO is to raise funds. The other one is liquidity. So the early investors and the company's founders, they must have put in a lot of effort. They must have actually risked a lot of money in investing in the company and building it up. So now once they feel they want to kind of capitalize on their investments, that means they want to make some liquid money, rather than holding the shares which are valued at X rupees. So they can kind of sell off those shares. So only if the company is listed on the stock exchange, this process is possible. Else they would be having to find out individual investors or uh, people who are willing to purchase shares. So the process of IPO, it makes the entire process very easy, that anybody who is having access to the stock exchange is able to purchase the shares that they are listing on it. So that is one more other reason, liquidity. And another reason is not so important, it is dividing risk. So let's say that a business is kind of getting into a business venture that they are not so sure about, in the sense if it is going to succeed or not. Obviously they're going to get into the business to make money, however they're not so sure if this business is going to succeed. Now, instead of risking the entire money of the investors, or the early investors or the founders, if the company has undergone IPO, now the public also has some ownership in the company. So the risk is kind of getting divided amongst all the shareholders, rather than completely by the investors, early investors and the founders. So all the investors are having equal risk on their capital, because they are all shareholders. So that is one more reason why companies go public. And it is also a method to increase the market valuation of the company if it is listed on the stock exchange. If there is a good demand for the shares of the company, if the company is doing good, people are monitoring it, and if there is a good demand and many people are willing to purchase the shares, obviously the price of the shares are going to go up. And if the price of the shares are going up, that means the market valuation of the company is also going to increase. So that is one reason why companies list themselves. And apart from these reasons, like, there have been reports which said that the management seems to be more actively participating, or seems to be more responsible if a company is listed public. Now, the valuation of the company, or the valuation of the shares of the company, is also dependent on the emotions of the public. So only if the public feels that the company is doing good, the market valuation will increase. That means the price of the shares will increase. So this tends to make the management more responsible. So these are some of the reasons why companies go public. Now let's also have some of the negative factors of a company going public. So one reason is that if a company is public, that means they have to please their shareholders. And at times, the founders may lose complete control on the decisions that they used to take initially in order to please the other shareholders. And apart from that, the market pressure, that means the overall sentiment of the economy or the overall sentiment in the stock markets is going to definitely affect the pricing of stocks listed on the exchange. For companies that are newly into business, the process of listing it on the stock exchange is a bit expensive. Not a bit expensive, somewhat really expensive. So that is one more negative side. And at the process of undergoing an IPO, the company is also having to list a lot of information that was earlier confined within their management to the public or to the SEBI. So this kind of gives an unwanted advantage for the competitors of the company because they get a lot of data directly from the management, which was not earlier available. And some of you must already be familiar with the concept of short selling, where people kind of expect the price of shares to go down. So they sell first and buy back at a lower price. So this is also creates a negative influence on the pricing of the stocks when people short sell it. That means people kind of sell it off initially and they buy it back at a lower price. So this is also another negative influence when the company is listed on the exchange. Now let's have a look at the difference between trading and investing. Trading is a phenomenon where you're kind of speculating the price of stocks, whether it is going to go up or whether it is going to go down. And you kind of really don't have any long-term approach with the stock or any long-term commitment. So it is all short-term, and you also have the opportunity to make money if the price of the stock is going up or if it is going down as well. So trading is a short-term phenomenon where you enter and exit seeing opportunities. So if the price is going to go up, you buy and sell at a higher price. If you feel the price is going to go down, you sell first and you buy back at a lower price. So you're kind of becoming an opportunist when you're kind of thinking about trading. While talking about investing, it is a long-term commitment. So if you feel that a business is going to do good in the coming years and you understand that the management is really great and the competitors don't have any advantage over the company you're going to invest in. The government policies are supportive with the companies or businesses. If you feel so, then you can kind of invest in it, expecting a return in the long term. So it's just like planting a mango tree, you kind of look after the plant for 3-4 years before you expect a fruit. So that is the kind of approach you adopt while investing, and you are going to make money only if the price of the stock is going to go up. While in case of trading, you also have opportunities to make money if the price of the stocks are falling down. So investing is a long-term approach, just like planting a mango tree, while trading is short-term. It is like you kind of throw a stone at a mango fruit to get the fruit. So if you kind of have the right skills and aim, you're going to get the mango. If not, if it kind of hits somewhere else, let's say it breaks somebody's glass, okay, so it's going to cost you a lot, it's going to hurt you. Okay, so investing is a long-term approach. So let's say you can be investing for over 1 year, you can be investing for 5 years, 10 years, or even lifetime. That is like you're kind of holding on the stocks for your entire life. Now talking about trading, it can be within you're kind of entering and exiting within seconds, within minutes. You're holding it for like days or a couple of weeks or months. So trading is a short-term approach while investing is kind of long-term. You're just becoming like a business partner. While trading, you're just making use of opportunities. So that is one main difference between trading and investing. When it comes to trading, whether the markets are moving up or down, you have the potential to make money. If the market is moving up, we take long positions. If the market is falling down, we take short positions. We'll explain about those in detail in the coming slides. And in trading, we have higher reward potential. However, the risk associated with it is high too. So it's always higher the risk, higher the reward. When it comes to trading, people look forward to trading as an active source of income where they do it on a daily basis, expecting profits, and it can be considered as a full time profession once you're getting comfortable with the skill. Now, let's quickly see about investing. Now, when it comes to investing, you make money only if the price of the shares are going up. So, let's say that I'm investing 100 rupees in purchasing one share of a company which was valued at 100 rupees today. So let's say after 1 year the price of the stock is becoming 120. So I'm receiving a capital appreciation of 20 rupees, that is 20%. So that is what I receive, capital appreciation on my investment. And apart from that, if the company is making some good profits, the management can even decide to share a part of the profits that the company makes with its shareholders. So decides to issue dividends to the shareholders, which is nothing else but a part of the profit share that the company makes, which is given to its shareholders. The company can also decide to reinvest the profits back into the business. So it's completely dependent on the management whether they are willing to issue dividends or not. So many people consider dividends as a factor while selecting companies when it comes to investing. So they look for companies that are issuing good dividends to invest in. So it also acts as a driving factor for investors to pick stocks which has a good track record of issuing dividends. Apart from all these, people consider investing stocks as their liquid assets. Liquid assets means you can easily exchange it with cash. So liquidity is nothing else but the ease with which something can be exchanged for money. So let's say I have 1 acre of land or I have like 10 flats in Kerala. However, the problem is that these assets is not so liquid, in the sense it is a really tiresome process to find a buyer who is willing to purchase it from me at the price I'm mentioning or the price I'm specifying, and it's kind of a long process. When it comes to stocks, stock market investments are liquid, in the sense if you have 1,000 shares of Reliance and the next day you want to sell those shares, you can easily sell it off in the stock exchange. And since the stock exchange is a very active place, there are always many buyers and sellers who are looking forward to purchase and sell, and you can easily capitalize and uh, exchange it with cash. So that's another advantage of investing. It is you are investing in liquid assets and you can easily exchange it with cash. So I hope you have got some idea about trading and investing. So apart from this, the fact is that you can make money both with investing and by trading as well. And it's always suggested that you have both a trading portfolio as well as an investment portfolio. So the trading portfolio is going to give you an active source of income where you are making use of your trading skills to make money, whereas your investment portfolio, if you are picking out the right stocks and if your view is correct, it is going to generate you passive income over the years, and you can completely depend on it for creating wealth in the long run. As a person who is going to trade or invest in the Indian stock markets, NSE and BSE are the two exchanges which is of significance to us. So Nifty 50 is the index of the National Stock Exchange. So the National Stock Exchange was recognized as a registered stock exchange in 1993 and presently has over 1,600 companies listed on it, whereas the Bombay Stock Exchange was recognized in 1957 and has over 5,000 companies listed on it. And Sensex 30, it is the index of BSE or the Bombay Stock Exchange. Index or indices are benchmarks that we use to measure the performance of various stocks or sectors of the stock exchange as compared to the average. So, investors or traders may use indices to understand how their portfolio is performing as compared to the benchmark index. It can also be used to define how the overall sentiment of the market is over the particular day, hour, or the month or the year. So, benchmark as a whole of the overall performance of the stocks listed on the stock exchange. Now, I'll just show you how the Nifty 50 index and the Sensex 30 index is calculated. We are having a look at the website of National Stock Exchange, nseindia.com. So if you visit the website, you can click on the home. So this is the landing page, and over here what we see is that currently the value of the Nifty 50 index is 11,720.25 and the percentage change is 0.5 percentage, that is 58.4 rupees. So the index has moved up by 58.4 rupees today or by 0.5 percentage. So I'll just show you how the index is calculated. I'll just give you an explanation. So we see that there are 31 stocks which are advancing in the Nifty 50 and only 19 stocks are declining in the Nifty 50 presently. So Nifty 50, the index constitutes of 50 stocks in terms of market capitalization listed on the National Stock Exchange. I'll just show you, it might be a bit confusing for you now. So Nifty 50, the value of the index is actually calculated as a weighted average of the top 50 companies in terms of free float market capitalization that is listed on the National Stock Exchange. So each company is given a different weightage on the index depending on the free float market capitalization. The leader is HDFC, as most of you know. So now the performance of these top 50 companies that is present on the National Stock Exchange, listed on the National Stock Exchange, will determine the value of the index. So the value of the index is considered taking into consideration the performance of the top 50 companies in terms of market capitalization. So free float market capitalization is nothing else but the money that has been raised by the company by listing the company on the respective stock exchange. So in terms of that, the company that is leading, the company that has raised maximum amount of money in National Stock Exchange out of the nearly 1000 total companies listed on it will come in the Nifty 50 index, and their performance as with respect to the proportions they hold in the index is being used to calculate the value of the Nifty 50 index. So it keeps changing depending on how the value of the different stocks in Nifty 50 changes. However, this benchmark can be considered to measure the overall sentiment of the market. So since the top 50 companies in terms of free float market capitalization is there in Nifty 50, it gives you an overall idea of what is the sentiments of the buyers and sellers in the exchange. which direction is the market heading to, or what is the outcome of the public, or what is the view of the public on the present economic situations. So we kind of get an idea about that looking at the index. So this is the site of NSE India. Now when it comes to BSE, Bombay Stock Exchange, just Google BSE and you will go to bseindia.com, the Bombay Stock Exchange site, and you also have a provision to see the Sensex value. Right now, the BSE Sensex is trading at 39,881.17. That is a change of 0.37 percentage, an increase of 145.64 rupees today. So this increase of 145.64 rupees, you can also mention it as an increase by 145.6 points. So 1 point is 1 rupee. Now, if you want to see the companies that constitute the Bombay Stock Exchange, you can click on it. So these are the companies which constitute the Bombay Stock Exchange Sensex index. So it's a list of 30 companies. So that's the reason we call it as Sensex 30 as well. So as you can see, Nestle India, Hindustan Unilever, Bajaj Auto, all other major companies, you are familiar with all the names, right? So these are the companies which are leading in terms of free float market capitalization of the Bombay Stock Exchange, and that's the reason they constitute the BSE Sensex index. I guess I didn't show you on the Nifty 50 side. So if you click on Nifty 50, you can also see over there the companies that constitute, sorry, not this one, nseindia.com. You can also see the companies that constitute the Nifty 50 index. So there's a mathematical formula associated in calculating the value of Sensex and of Nifty index. However, is of least importance to us because we readily get the values and we don't have to calculate the value separately. So now you can see the top, the 50 companies that are constituting the Nifty index to SEAL, JSW Steel, Bharati Airtel, IOC, Vedanta Limited, Reliance, and you must be familiar with almost all the names because they're the top companies in India as well, not just in terms of free float market capitalization and National Stock Exchange, but they're the market leaders of their respective segments. So I personally have a look at the Nifty 50 index because it takes into consideration 50 companies rather than Sensex taking into consideration 30 companies. So it kind of gives us a better understanding of the overall sentiment of the buyers and sellers in the stock exchanges. So I hope you got an understanding how the index is calculated. So what we should understand is it is a benchmark that we take into consideration to see what is the overall sentiment of the market. Now when we look at the stock markets, there are basically two kinds of market conditions. The first one is bullish and the other one is bearish. So when I say bullish, so what I mean is the price of the stocks are continuously moving up. And in a bearish market, the price of the stocks are falling down. So if somebody says the stock is bullish, so what he actually tries to mean is that the price of the particular stock is moving up. And if someone says the stock is in a bearish trend, so he means that the price of the stock is falling down. So when he mentions the stock is bearish, the reason why the term bullish and bearish is because of the manner how bulls and bears fight. So if you have seen a bear fighting, so the bear kind of taps with its arms in a downside direction, and that's why a downside market is called as bullish. And talking about a bull, the bull attacks with its horns, picking you up from the ground in an upside way. So it kind of attacks in an upside manner, and that's the reason an upside market is called as a bullish market. So the market constitutes of both the bulls and bears and is not just bullish days all the time. It will be a combination of both bullish and bearish days. On the bullish days, one looks forward to take long positions, and in bearish days, most of the times one looks forward in taking short positions. So in the next PPT, we'll see what short and long positions mean. So now let's have a look at some terminologies that you're going to hear so often from now on. So the first one is long position and the other one is short position. So as I have told you, in case of investing, you're going to make money only if the price of the stocks are going to go up. So you're going to take delivery or you're going to invest in the stocks and are going to expect the price of the stocks to go up. Now, talking about long position, when it comes to trading, it is actually you are buying first at a low price and you are going to sell it off at a higher price to make profit. So if you feel the price of the stock is going to go up, you can go for a long position, meaning you're going to buy first at a low price and you're going to sell it off at a higher price. So that is what we mean by long position. We're talking about short position. It is also called a short selling. So let's say that you have a view the price of the stock is going to fall down. So in that case, if you don't have shares with you, what you can do is you can short sell. So you're going to sell it off first and you're going to buy it back at a lower price. So initially you're going to sell at a high price and you're going to buy it back at a lower price once the price has fell down. So this is because of the fact that all the stock market settlements happen after the market closes at like 3:30 p.m. So at the time of closing, when they check, you have sold let's say 100 quantities and you have bought back 100 quantities. So the net quantity is 0 and that is totally fine. So yeah, you heard it right. You can sell off something that you really don't have. So if you have a feeling that the price of something, some stock is going to fall down, you can sell it off first at a higher price and buy back at a lower price to make profits. So it is true that you can make money even if the stock market is crashing by short selling. If your view is that the price is going to fall down, you short sell, you sell it first at a high price and buy it back at a lower price at a later point of time. So there are many cases when we hear very negative news about stocks. So one case is when the Punjab National Bank issue, when we heard that Nirav Modi he has escaped the country after borrowing a lot of money from major banks, especially the Punjab National Bank. So it was a sure shot thing that the next day the price of Punjab National Bank shares are going to fall down. So somebody who had shares of Punjab National Bank, if he feels okay it is going to drop so much, he might consider exiting his positions. Because it's going to be a very sharp fluctuation that is going to happen. Now let's talk about somebody who doesn't have shares of Punjab National Bank. So consider that you're borrowing shares from someone else who is having shares of Punjab National Bank. You're selling it off as the market opens because you feel the price is going to fall down. So you sell it off initially, the borrowed shares that you have borrowed from somebody who is having shares of Punjab National Bank, you're selling it off first and you're buying it back at a lower price at a later point of time. So the difference between the higher selling price and the lower buying price is going to be a profit. Now you buy back those shares and you return the borrowed shares to the person from whom you have borrowed. So the process is not as difficult as I'm saying. It is the same method as you buy, or it's the same method as you buy. It's the same process that you're going to do for short selling. You're just going to click on the sell button first. So that means you're going to sell off the positions first and you have to buy it back before the market closes at 3:30 p.m. on the same day. And you square off your positions, make the net quantity 0, and it's perfectly fine because at the time of settlements when they check you have sold let's say 1000 quantity, you have bought back 1000 quantities. So that is the phenomenon of short selling. If the price is falling down, you can make money by short selling. You sell first and buy back at a lower price. So that is how you can make money in negative markets when the price of stocks are falling. So now let's have a quick look on how to read about stocks on the Nse India website. Apart from that, we'll also look at moneycontrol.com, one of the best websites for following news and to get data about the stocks on Indian markets. After that, we will move forward to read candlesticks on our Demat Brokers platform. So now we are on the website of Nse India, that is of the National Stock Exchange, and over here we can see the details of the index. So apart from the Nifty 50, that is the major index, there are other indices like Nifty Next 50, Nifty Mid Cap 50, Nifty Auto, which takes into consideration the automotive stocks, and Nifty Bank, which takes into consideration only the banking stocks. Fine. So now let's quickly have a look, a quick overview of the website. So you can see the chart over here with advanced decline. So what advances mean is the number of stocks whose values increased on the particular trading day, and declines means the number of stocks whose values decreased. 21 stocks whose values decreased. Unchanged means it neither moved up nor came down. Now looking at this box over here, it gives you an idea about the top gainers and top losers. So Asian Paints, Nestle India, Hindustan Unilever, Britannia, Bajaj Automotive, they are the ones which had a positive move, the maximum positive moves from Nifty 50 index. So we can see the percentage changes 6.34, 4.99 percentage, 4.82, 4.47, 4.44. So all these are for the very same day, and LTP is nothing else but the last traded price of the stock. Similarly, we can have a look at the top losers. So Infratel, Yes Bank, ITC, GAIL, TCS, they were the ones which were losing. So their values decreased by this much percentage compared to the previous day's closing. So that is what is indicated in this case. So we can see all the losers and all the gainers. Now on this chart, we can see what has been the percentage change of the top 50 companies in terms of market capitalization for the very particular day. So we can identify that. Now if you want to have a look at any particular stock, you can just click on that. So let's consider Britannia. Okay. So we are able to see the previous closing price of the stock, the opening price of the day, the volume weighted average price, the lower band, upper band. Now 52-week high low is displayed. That means over the duration of last 52 weeks, that is 1 year, what has been the lowest price and what has been the highest price achieved by the stock. Now intraday high and low is the day's highs and low. Okay, so what is the highest price achieved by the stock on the day? That is 3249, and the lowest price is 3092.35. So we see there has been a percentage change of 4.47 percentage for the stock, and presently the trading price is 3236.1. So these are the things which are most important from Nse India side. So at the opening hours, so as all of you know, the Indian market trading hours are between 9:15 a.m. and 3:30 p.m. for the stock markets, for the equities. Now looking at the top gainers and top losers during the morning hours, let's say after the first half an hour, like 9:40 a.m. or 9:30 a.m., it kind of gives us a sense of understanding which are the stocks that are trending on a particular day. So that you can kind of figure out stocks that are trending much during the initial hours by having a look at this website. It also shows us you also get data related to the pre-open market. So pre-open market is nothing else like even before the market opens, there is something called as a pre-open market hours. And today, if we look at the pre-open market hours, pre-open market data, the market showed a negative sentiment. So in the pre-open market, that is like the pre-open market updates closes at 9:08 a.m. And if you look, the declines were more than the number of advances. So it was showing a negative sentiment in the pre-open market. So what we understand over here is that the stocks that were gaining the most during the pre-open market hours were SEAL, IOC, IndusInd Bank. So these were the ones. Now on the negative side, Asia Motors, Gale, ITC, they were the ones which were kind of losing much. So we kind of saw the data of the pre-open market, and we kind of also saw the top gainers, top losers, what was the last traded price, what was the percentage change. Now talking about the volume, so volume is nothing else but the number of transactions of a particular security, of a particular share. So let's say that I'm selling you two shares of Asian Paints. So now the volume is two. Now if you're selling the two shares that you bought to someone else, okay, you're selling off the two shares that you bought to someone else. Now the volume becomes another 2 is added and the volume becomes 4. Now say that the person whom you sold to, he is selling only one quantity of the share that he bought, that is 2 he bought, only one quantity is being transferred to someone else. Now the volume becomes 4 plus 1, 5. So it is the number of transactions of the share that is happening that we consider as volume. So now let's have a look at the site of money control. So money control, the use of this website is that you get a lot of news related to the stock markets, the global news as well. Apart from that, like what all are happening in our country regarding the economy, especially regarding the economy and other factors as well. So it's a very good site to follow news. We kind of get to know which all stocks are having any particular news associated with it. And see, one more thing I would like to say or mention over here is that just because a stock has a news associated with it doesn't mean it should move according to the direction of the sentiment that the news provides. It just tells us that okay, many people will be watching out for the stock, and many people will be observing the stock, and there is going to be a huge volume. That means huge number of transactions that is going to be associated with the stock. Okay, so you won't be able to perfectly define which direction the stock is going to move completely upon the news, but you'll be able to figure out that there's going to be a lot of activity that is going to happen with the stock. In the sense, a lot of people will be closely observing it. That means it's going to have a higher volume associated with it. So now you can also get data regarding companies on money control website. So if you click on any particular stock, you'll get the data of what has been the price, what has been the high, open, high, low, close, all these values on both the exchanges. So this is the data of BSE, Bombay Stock Exchange. This is the data of NSE. Now we see that the closing price, like the last LTP on NSE India, NSEindia.com. So right now the market is closed. Right now the time is around 3:40. The market closes at 3:30. So if you kind of have a look over here, we see the previous closing price on BSE is 1383.3. On NSE it was 1383.35. There's a small difference. We also get to know what is the LTP on BSE NSE sites. What was the percentage change? LTP means last traded price. So 1385.85 is the price on BSE, while on NSE it is 1385.5. Slight variation. The percentage change is 0.16 percentage on NSE, and on BSE it is 0.18 percentage. Now looking at the volume, that is the number of transactions of the Reliance Industries stock that took place. In the case of BSE, it was just 4,69,000, while in the case of National Stock Exchange, it was like 14 million. That is like 140 lakhs. That is the volume that happened in National Stock Exchange. So the volume is always usually like 20 times more on, usually like 10 to 20 times more on National Stock Exchange, whichever stock you're going to look at. And most people prefer National Stock Exchange for trading purpose as well, because of the fact that more number of people are trading on it. So if more number of market participants are there, that means you'll be able to perform a transaction at the price at which you desire.
So one basic example that I can give you is, let's say that there are only let's consider a case at marketplace A. There is only one person who is selling, and there are five people who are coming to buy. So if there is only one person who is selling and five people who are coming to buy, then obviously the seller is having an added advantage because he can kind of increase the price because five people are there willing to buy only, and only one product is there, so he can increase the price. Now the other way around, if there are five people who are there to sell and only one person is coming to buy, then the sellers, they'll decrease the price of the product because uh, the person who's coming to buy, he will only purchase from the place where he's getting it at the best rate. Okay, so there is difference between asking price and selling price is what we call a spread. So there's going to be a difference between the bid price. So bid price is nothing else the price at which people are willing to buy, and offer price is the price at which people are willing to sell. So the spread is usually lesser in national stock exchange. So that kind of makes it more attractive for traders, because when it comes to trading, this even these minute variations matter a lot. Now we also get the today's low or high value, 52-week low or high value, lower or upper price band. So lower or upper price band, it kind of is a you can call it as a boundary or a limit within which the prices tend to be moving on a particular day. So you can't kind of expect the price of a stock to fall down from 100 to 0 on a single day. So, and market doesn't permit such, what do you say, such sharp moves. To avoid that, the exchanges like they kind of set upper and lower price band, so that if the price reaches 1581, 1521, then the stock will get uh, frozen for some time. There can be cases when the price bands are revised, so that can also be there. So this kind of avoids such rapid moves in the sense something that is quite unnatural. Okay, so for that purpose we have lower or upper price bands. So now we have got some understanding about how what are things that we have on the moneycontrol.com. We also get the market capitalization, P by E ratio, which is nothing else the price to earnings ratio, meaning how much price you should be paying to earn 1 rupee from the Reliance Industry stock. So all these kind of details are there. So all these things come into like it is useful when you're kind of calculating the target price based on PE ratios or when you're looking forward to investing. So these things are very important. So we also kind of get a sense of understanding what different technical indicators are giving us. So now we have seen the website of Nse India. We have also seen the moneycontrol.com, which is very, very good for following news related to the markets and getting information about like what is happening around the world, all these things. So now the next thing is what a demat account means. So just like we have our bank account for storing the things, for storing our money or for purchasing things from the supermarket, we use our bank account, right? You use your debit card, you use your credit card, all these things. Now, when it comes to purchasing stocks, we have something what we call as a demat account, a dematerialization account, where the stocks that we purchase is getting stored. And we have brokers like Seroda, Upstocks, Kotak Securities, Motilal Oswal, and many others who provide broking facilities. So always when we want to purchase a stock or when we want to sell off a stock, it is through our stockbroker that we perform the transactions. It is not like we can directly go to the stock exchange and place a buy order or place a sell order for a stock. It is always through our stockbrokers that we perform the transaction. So this is the platform of
Upstocks, the online platform for Upstocks broker. So we have the facility to see what the indexes, what the Sensexes, what the Nifty values. MTM shows the amount that you have made, your client code, the balance. Apart from that, you have the provision to add other widgets like charts, positions, holdings, etc. etc. Now, one more thing is you can create a watch list. That means the stocks that you're following, the stocks that you are observing closely. So right now the stock markets are closed is 9:15 a.m. to 3:30 p.m. as I have mentioned. However, the commodities market, the crude oil is still active. So the crude oil trades from 9 a.m. to night. The markets are open till night 11:55 p.m. Right now, we are able to trade crude till night 11 p.m. Okay, so the crude oil markets, the crude oil commodity is usually preferred by working employees because for them during the normal market hours they have office hours, but when it comes to crude oil, they have time in the evening to trade crude because crude oil markets are open till night 11:55 p.m. is available for trading till night 11 p.m. So right now we are seeing the chart of crude. We see that the price of crude is still deviating, is will be deviating throughout. So this is due to variations in supply and demand. Now through your demat account, demat brokers platform, you can place your order whether you want to buy or you want to sell. Now you also have the provision to mention how much target you're looking for, at what price you want to buy, at what price you want to sell off in case you're losing. If at what target price you want to look for. That means let's say that I want to buy at 3,700. Now if I feel the trend is going to be up, then I'll buy, right? Let's say I want to buy at 3,700. If I'm looking for a target of 10 rupee, that I can mention 10. If I'm keeping a stop loss is the maximum risk I'm willing to take. So many of the people still are not aware of the fact that you can limit your loss by keeping a stop loss. So if you feel that, what do you say? If you have a limitation, that means like the maximum amount you can afford to lose. Okay. If there is a maximum amount you can afford to lose, then what you should be doing is you should not be risking more than that in any particular trade. So let's say the maximum amount I can afford to lose is let's say 100 rupees. Then what I should be doing is I should mention my stop loss accordingly. I should be mentioning my stop loss based on levels. So it's actually beyond the scope of this session we are having now. I should mention the stop loss looking at the levels and I should calculate my positions accordingly. So let's say that I have to keep a stop loss of 10 rupees itself. Then the maximum quantity I can buy in the case of crude oil is in the case of crude oil, the maximum quantity I should be buying is this is the major crude oil contract, the mega contract. So 10 rupee is not like 100 rupee loss is not possible because when it comes to crude oil, 1 rupee move, like every 1 rupee move makes a loss of 100 rupee. Okay. So in this case, let's assume that the maximum risk I can take on my trading account is 1000 rupee. Then if my let's say my stop loss is like 10 rupees away from my entry point, then the maximum quantity I can buy is one quantity. This is one lot. That means if there is a loss of 10 points, I'll be losing 10 into 100, that is 1000 rupee. It's better that I explain in terms of stock. So let's assume that let's consider Tata Motors. So I'm just opening the chart of Tata Motors. So right now the price right now it closed like at 164.4. I'll just give you an example. So let's say that I want to purchase shares of Tata Motors and I see that I can look for a target of like 3 rupee, or let's say to be more reasonable, let's say I can look for a target of 2 rupee based on strategies. So discussing strategies is kind of beyond the scope. So let's say I can look for a target of 2 rupees and the risk I should be taking
and I understand that based on levels, the stop loss I should be keeping is like 1 rupee. So my risk I'm taking on one quantity is 1 rupee, and the target I can be looking for is like 2 rupee. Now let's suppose that the maximum risk, okay, that is the maximum amount I can afford to lose from a trading portfolio is 100 rupee. In that case, at maximum I should be buying 100 quantities because my risk is 1 rupee. So even if I'm going in loss, 100 into 1, 100 rupees is going to be my loss. Suppose the maximum risk I can take is, let's say, 350 rupees. Okay, in that case, the maximum quantity I should be buying is 350. Now let's assume that based on levels, my stop loss is like 0.5 rupee. Now, if my maximum risk I can afford to take is like 350 rupee, in this case, I'll be able to purchase 700 quantity, because if I purchase 700 quantity, a loss of 0.5 rupee per share will cost me a loss of 350 rupee. If I'm looking for a target of 2 rupee, if my target is getting achieved, I'll be getting 1400 rupees. So this is one basic understanding I can give you about the DMAT platform and the money that you add to your DMAT account. So people usually have this doubt: if I add money to my DMAT, if I purchase a stock, will I lose money from my bank account? No. So you're using your bank account only for the purpose of adding money to your DMAT account, and all the profits that you make, or when you want to make a withdrawal back to your bank account. So you click on withdraw, you withdraw the money back to your bank account. So once you add funds to your DMAT account, the fund that is there in your DMAT account is the only one that is going to be used for purchasing stocks, and nothing else is going to be used. So please understand that the money in your DMAT account is the only one that is going to be used for purchasing stocks, and when you sell stocks, the money is coming back to your DMAT account, and now you need to make a withdrawal to your bank account to get the money back in your bank account. Okay, so you can add stocks. If I want to add a new stock to the watch list, I can, if let's say that I want to add a stock like uh, a Reliance Power, then I can click on add. I can search for the stock, I can add it to my watch list, and I can observe it. So it's completely up to the individual, like which all stocks is going to monitor, which all stocks. So everybody has a favorite list of stocks. So this is not my favorite list. So this is a different list. Okay. So this is what we call as a watch list, the stocks that we are closely observing, and this is the platform of DMAT. So this is a place where you're kind of able to see the charts of stocks, of commodities, and whatever that is tradable. You can also see the forex pairs, USD, INR, and all in this platform. So now we have had a brief introduction about the DMAT account. So now if you're looking forward to start a DMAT account with Upstocks or Zerodha, we could help you with the same. We have our own team who could help you in the account opening process. And all you need to start a DMAT account is a Aadhaar card, a PAN card, and you should be having a bank account, obviously. So the account opening process is all online, and it's just a matter of like 5 to 10 minutes to sign up for a DMAT account. So once you sign up with your email ID and mobile number, you can finish off the process in like 5 to 10 minutes once you sign up, and that marketing team from Upstocks or Zerodha will be contacting you back depending on the option that you choose. You can either choose to go for Upstocks, Zerodha, whichever you want. So both the platforms are almost the same. Talking about the charges, when it comes to Upstocks, the account opening is free, and you get a free stock as well when you are creating a DMAT account. When it comes to Zerodha, the charges are 300 rupees on DMAT account opening. So we have seen how a DMAT account, like DMAT platform looks like. So you can also change the color, all these things, not so relevant, but just for your knowledge. Okay, so many functionalities are there, and we have different order types that we can make use of depending on the strategy that we are implementing. There are multiple order types that one can kind of look out for. Keeping a stop loss, that means you're defining your risk. Target means the amount at which you want to sell off for these things. If you want to sell, if you want to short sell, you just click on sell and you perform the trade. If you want to buy, you toggle it to buy, and you perform the trade. You can mention the quantity, the price. So many different order types are there, many other functionalities are there as well. So now we have also seen how a demat account platform looks like. On our website itself, like there is a link on how to start a demat account on your page, on the website page itself. So now let's quickly have a look about the opening high, low prices as being indicated in a candlestick. So now do you see this green candle? And in the green candle itself, I suppose you are able to see the region marked as the open and the region marked as the close. Okay, so the area within the opening and closing levels is what we call as the body of the candle. If you see the color of the candle to be green in color, so what it indicates that the price of the stock or the price of the commodity has moved up in that particular interval of time. So right now what we see is we have the opening price at the bottom and the closing price at the top. So that means during that interval of time, definitely the price of the stock has moved up, and as a result the color of the candle is green. And above that we see a thin line below the opening level and a thin line above the closing level too. So they are what we call as shadows or candle wicks. So what usually happens is, if the price opens at a particular level, that doesn't mean the price should continuously move up till the closing. It can initially fall down, then it can pick up from that point due to an increased demand, and again it can move up. Now on the upper wick, what has happened is the price reached that highest point, then from there the price has dropped and came down and closed at a particular level. So these are what we call as candle wicks, and the region within the opening price and closing price, that is what we call as the candle body. That will be the portion which is shaded with either green or red color. If the color is red, what it indicates is that the price has decreased during that particular interval of time. So as you see in the red candle on the right hand side, what we see is the closing price is lower than the opening price. That means the price of the stock or commodity has dropped down in that particular interval of time, meaning it is a red candle showing that the price has dropped during that particular interval of time. So here we haven't mentioned any interval, so the interval can be 1 minute, it can be 3 minutes, 5 minutes, 50 minutes, 1 hour, 1 day, or a 1 month candle as well. So the interval depends upon the time frame that you select on the demat brokers platform. And the candle wicks, what it indicates is at the top is the highest price achieved by the stock at that particular interval, and at the bottom wick will be lying at the point where the lowest price is achieved. And there can be cases when there is no wick at all. That means there is no candle shadow or candle wick at the top or bottom. So let's say there is no wick at the top. So what actually it means is that the highest price and the closing price is the same in case of a green candle if there is no wick at the top. And in the case of a red candle, if there is no wick at the top, what it means is the opening price and the highest price is the same. After opening, it continuously fell down, that means. Okay, so now let's quickly have a look at some of the candles on the Upstox chart. So right now we are having a look at the chart of crude oil because that is what is open right now. The crude oil market is only open right now. So let's see how the candles are getting formed. I'm switching to the white shape. So we have selected the interval as 5 minutes. I'll show you. See, we have different intervals of time. So right now what it indicates is that one candle depicts the change in price for the underlying asset. Here it is crude oil for that particular interval of time. Since it's 5 minute interval, so what it shows is whatever happens in 5 minutes, that is being shown. So what I understand over here is this was the opening price of the minute of the 5 minute group. This was the opening price at 4:30.
Now the price has moved up, made a high point over here. Okay, this was the highest price achieved by the stock. Then it made a low over here. This was the lowest price. Okay, now the lowest price and the present price is the same. It has moved up. Now the lowest price and the present price is same. So this kind of keeps changing throughout the minute. Now I'll just show you in the 1 minute candles will be something different now. So if you see the 1 minute candle, so this is the opening price, this was the lowest price, this is where the present price is. Now I'll show you when the minute ends too. So we'll see where the closing is compared to the opening. So that will depict the color of the candle. Now if the price moves above the opening price, the color of the candle will become green. Let's see. So this is showing us a minute by minute interval data of the candles. Let's kindly have a look. It keeps on changing, even the color of the candle can change too, but once that particular interval of time is open, is same. So now the minute has closed. Now this is the next minute candle. So the opening was here, so there is no upper side wick. That means the opening price and highest price of the particular interval was the same. This was the lowest price, this is the closing price. Now this is the opening price, this was the highest price. Now it is still at the opening price. That means there was no color earlier. So now it is moving up. Let's see what happens, and let's see the color of the candle. So now the candle is now okay. So that was a good upside move. So 704 to 708. So we call it as a 4-tick move. 4-tick move. That means it's like a for per lot, it's like a 400 rupees profit. That means for one lot you need like 10,000 rupees. So with 10,000 rupees you would have made a profit of 400 rupees if you bought over here. So this minute has ended. The opening price was here, the highest price was over here, and the closing price is over here. Okay, so this is the case of the crude oil. Like it's the same thing. This is the same phenomenon with all the charts. So we call it as candlestick charts. I'll show you one more chart of Tata Motors. Now, if we kind of have a look at the charts of Tata Motors, I know we are seeing the 1 minute candles. The market is closed, that's why it's not moving. So if I want, I can kind of switch to the 1 day charts. So if I switch to the 1 day charts, what happens is each candle depicts 1 day interval of time. So now what I see over here is the opening price was over here, the highest price is over here, the lowest price is over here, the closing price is just a bit above the opening. Closing is somewhere around 163.7, opening is like 163.5, just a 20 paise move. That's why you see it's a green color candle itself, but like so small, the body of the candle is very small because of the same reason. So now we have seen how candles, the colors of candles, what they mean. Green color means the price has moved up, it's a bullish candle. Red color means the price has fell down, it's a bearish candle. So now when it comes to trading or when it comes to investing, we make to look out for two kinds of trends. Majorly the uptrend and the other one is downtrend when it comes to trading. So in an uptrend, as we see in this picture, there is usually a combination of higher highs and higher lows. That means the first a high gets formed, then the price falls down a bit, forms a low, again a high is getting formed, but this high that is getting formed is higher compared to the previous high that was formed. So compared to the first high that gets formed, the second high is higher compared to the previous high, and hence we call it as a higher high. Then once again the price is dropping down, forming a low, but this low is higher compared to the previous low that initially got formed, and hence we call it as a higher low. And in an uptrend, we usually see a combination of higher high and higher low formation. So in an uptrend, when the demand is more than supply, that means the number of buyers is higher than the number of sellers, and this phenomenon causes the price of the stocks or commodities to move up, and that is why we see a higher high and higher low formation. And we can't never expect a trend where the price continuously moves up in a spike. Okay, just in a single spike, the price continuously moves up. We won't be seeing that. It'll only be a step by step upside, downside, upside, downside, and the same pattern of movement. Because initially, once the high is getting formed, many people will sell off their positions because they must have bought at lower prices. Now, once they sell off, they book some profit. It is called as profit booking. Then the price drops a bit. When some people who earlier bought, they start booking profits, the price drops a bit. However, once the price drops a bit, people feel okay, this is a good time to enter, and they buy, and the price moves up. So an uptrend is kind of usual when you look at bullish days. We can kind of find out many stocks which are coming under the uptrend, like perfect higher high, higher low formation patterns. So this is kind of a great trading opportunity to identify when you are capable of identify these kind of trends. Let's say in the hourly charts or even in the weekly charts, this is a great trading opportunity. You can also use it for day trading purpose. There are n number of opportunities which happen on a daily basis. Now talking about downtrend, downtrend is a case when the price initially falls. Talking about downtrend, downtrend is a pattern or a trend when the price initially forms a low followed by a high, and then again it drops much more, forming again a low which we call as a lower low, and then a high which we call as a lower high. What happens is that the first low is always the second low that gets formed is lower compared to the previous low, and as a reason we call it as a lower low, and the high that is getting formed, that is also lower compared to the earlier high that got formed, and hence we call it as a lower high. So a downtrend is a combination of lower low and lower high formations, and it happens because a downtrend happens or a bearish trend happens when the supply is more than the demand, meaning the number of sellers is higher compared to the number of buyers, and in turn this pushes the price down. Just like we had an explanation of when there are many people who are selling but only one person is coming to buy, so the sellers negotiate, the sellers are willing to sell it off for a lower price, which brings down the price of the stock, commodity, or whatever is being traded. So these are the usual kind of patterns one looks for as a trader, or let's say a positional trader or a day trader. These are the usual kind of patterns one looks for in the markets. So every stock at some point of time faces rejection from some particular levels which we call as resistance levels, and they face bouncing up from particular levels which we call as support levels. So when it comes to trading, when it comes to day trading especially, the identification of these support and resistance zone is of the most significance as far as a trader is concerned. So we kind of identify the regions from where the price is bouncing up and the regions from where the price bounces down. So getting an understanding of this pattern is what most successful traders follow, and it also helps you in determining the possible target levels that you can look for and the risk that you should be taking in the trade that you're entering. So when you find that the reward or the target that you can look for based on the levels is higher compared to the risk that you're taking in any such trade, that is when you decide, okay, this is a good trade because the reward I can look for is much higher than the target, is much higher than the risk I'm taking. So let it be anything, the reward that you can look for should always be greater than the risk you should be taking. So when you find opportunities such a way you find more reward potential than the risk that you're taking, so that is when you decide that you should be entering this particular trade. So there are a lot of other conditions too that you should keep in mind while entering the trade. So that comes along with the strategies, like that depends on the strategy you are following. Many of you must have heard people complaining that stock market is a place where people gamble, and it's absolutely wrong.
The reason is that stock market is all about statistics and understanding price action. I'll just tell you why. Most of you are already familiar that it's just 10% of the people in the stock markets who make money. However, still many are attracted towards it because they know this 10% are making some really big amount of money, and 90% of the people they are continuously losing money in the markets. The reason is because they don't have a proper risk management measures, they don't have a proper strategy that they have backtested and found to suit their trading style. So they get into the markets seeing random movies or seeing someone else making money from the markets. They really don't bother how much efforts the other person who is making money has put into to succeed in the stock markets. So just like in any other profession, so we should consider this as a long-term commitment where we practice on a daily basis, testing strategies, working on our emotions, reading technical charts, understanding about the companies before we get into the stock markets. So that is where most people go wrong. We have tools like stop loss, which kind of controls the maximum risk we'll be taking. In the case, let's say the maximum amount I can afford to lose is 2% of my trading portfolio. So even before I enter the particular trade, or even before I get started with investing, I can set the limit. So suppose let's say I have 1000 rupees in my demat account, the maximum risk I can take is let's say 50 rupees. So I can preset that. So as soon as I'm incurring a loss of 50 rupee, my broker will automatically send an order to the exchange to square off my positions. So the maximum loss I'll be taking, let's say, will be like in the range of 50 to 51 rupee. So these many tools are there for us in this modern age to control our risk and to concentrate more on our trading strategies, and many other technicals and many other level based indicators are too there which can help us. So now you should correctly have a good understanding of price action. That means what each candle is telling us based on levels, and we should backtest strategies. Backtesting strategies meaning if you get to know a strategy rather than entering into the markets the very next day, it is highly advisable that we analyze the markets without real trading, just looking at the charts, applying the strategies, and just observing for a period of like 2 weeks. So now, once we do that, we get comfortable with the strategies. We itself get a confidence that okay, based on the strategy, last 2 weeks I got like 10-15 trades. Out of 10-15 trades, if I'm getting like 7 winning trades out of 10, that is good enough, because we also apply risk to reward ratios for entries, meaning if I'm going to go for an entry, the reward I'll be looking for should be higher than the risk I should be taking. So nobody should be entering a trade or should be entering into a position where you're risking like 10 rupees to achieve 5 rupees. We should do the other way around. When you're looking for 10 rupees, the maximum risk you should be taking should be 5 rupee, so that probability will be in your favor, and in the long run you will always stay in green. So this is more of a statistical approach when it comes to trading, combined with emotions and discipline. That is what is going to help you master the stock markets. To conclude, we understand that stock market provides immense opportunities for income as far as an individual is concerned. So one can gain active income being a trader, and he can look for passive income by being an investor. Now, rather than starting a business, if you feel that the business model associated with a particular company listed on the stock exchange is great, you can invest in the company. That gives you more freedom in terms of time. The business is going to grow, you are going to get a good return on your investment. So stock and index based investments has always outperformed bank based deposits in the long run. So for somebody who is looking forward to gradually build a wealth, to gradually build a portfolio, to create wealth in the long run, you can definitely consider investing in stock and index based funds.
So we have seen about the basics of stock markets, the major stock exchanges, how to read the stock, and the bullish market, the bearish market. Apart from that, we have learned about long positions and short selling positions, how to start a demat plus trading account. We have discussed a bit about support and resistance levels, and we have concluded about the importance of stock markets and the opportunities in it. So let me congratulate you because you already know more information about stock markets than 99% of India's population now. If you're looking forward to learn advanced trading strategies of the stock markets for equities, commodities, futures and options markets, you may feel free to contact us through our website www.livelongwealth.in. We provide online and offline courses for both students, working employees and retired professionals based on your requirements.